Hi, everyone. I'm Maggie Lake, talking market today with Cem Karsan, founder and CIO of Kai Volatility. Hey, Cem, it's great to see you.
Good to be back. Good to see you after a little bit of a break for
I
both of
know
us.
you are fresh off a much needed break. And I'm so glad you posted that because I think everyone needs a reminder sometimes that you just have to sort of pause and reset and really do that for yourself. And I feel like we're all going to need to do mini versions of that through what is probably going to be a really stressful fall. But how's reentry been?
Well, the problem I was saying earlier, the problem with taking time off is then you come back and you have that much more to do. So, really good to take the break for perspective, for a long-term kind of vision, and get the gratitude piece back down and connect with family, all those great things. So those are long-term benefits, right? Those aren't just short-term. But yeah, working heavy now, trying to catch up a little bit, and of course we came back because school starts, and then you know what happens in the fall when school starts, everybody comes back, and then the bug starts
Petri
going around. So I
dishes.
just caught something too. So I'm
Exactly. I just
yeah,
got off it as well.
yeah,
And I
everybody.
haven't even left my house, so I don't know how that's possible. But they just bring it in, those kids of ours.
Totally.
Well, it's great to see you back, and I know everyone was clamoring for it, and you were really missed while you were away. But we were super happy that you took that, and then we're nice enough to give us all a reminder. So, as always, wise investment advice when it comes to life, for sure.
I appreciate it.
So no easing in because let's face it, September's been a wild ride, right? US stocks actually ended the week here with a rally. US stocks managed to end up, and we've now incredibly almost erased that huge sell-off that ushered in the month. And we're back within striking distance of the all-time highs on the S&P. I mean, I actually couldn't believe it when I looked at the chart and saw that. It didn't seem like that was remotely possible just a couple of weeks ago. But give us your sense of what's really driving this, because I know you look at the market really through a different lens that most of us don't have access to.
Yeah. So SEP OPEX is a big OPEX. It always is. It's a big part of the seasonality of why September is such a bad month historically, right? And SEP is bad, but if you look at mid-August to mid-September, it's even worse, right? That's really that expiration cycle. That's an issue. Quarterly expiration cycles in general can be very stressful, but they tend to, in other months like December and June, tend to be positive bias with fat left tails. And that's because you have a lot of holidays you have during that period that accelerates times, and you have other effects. Like in December, at the end of December, you have a reinvestment effect. So if the market's already up, you have a massive Jan 1 re-leveraging money coming in. We've talked about this on the show before, and all of those effects come together to make December a very, mid-November through really mid-January, that 2-month period, the most positive period out there. September has this fat tail. It has this vol that other quarterly expirations has, which makes it very volatile, and it doesn't have the benefits that Jan 1 flows. It sits on the other end of summer, where volatility is historically very low and compressed, and so it actually is driven by a lot of increasing volatility, right, as you come into the fall, as people come back. And so that pressure on volatility in the context of a lot of open interest in that SEP OPEX tends to create reflexively some volatility and some real tail events. So if you look at the distribution of how many times it wins versus loser, it's actually not that bad. It's just that when it loses, it's really bad. And I think that's really important to the story. So this time is no different in that sense. It is different in a couple of other senses, though. We have an election. So election years create a bunch of event vol, a bunch of risk behind September, when normally that's well supplied in November and December. And so that event vol in November makes it even more stressful because you can't hedge behind that September as easily, and it creates more open interest in the back half of the quarter and some more kind of tail interest there as well. So you take all of that in the context of kind of what we saw starting in August. That got started really in July, with mid-July, with a rotation out of the AI names that was driven by, again, not many people would agree with this, but this is my view, is driven by the option market primarily. You saw a 4 standard deviation move in July and late July between the Russell and the S&P, and that S&P underperformance was primarily driven by AI underperformance in the Mag 7 broadly. And so that really started to break dispersion in the market, and this massively leveraged dispersion trade we've talked so much about. And that stress in those parts of the market eventually led to a deleveraging in the broad market, and then started creating stress in different pockets like yen, the yen carry trade, and other things that really started to kind of break as vol increased, right as we're coming, like I was saying, out of the fall and into that SEP OPEX. So it's never the same exactly, but it always kind of rhymes, and the factors that drive that leverage, that tinderbox there in September are there and help really make the odds that we have, higher, that we have those kinds of events. So anyway, that's kind of a short version from a vol perspective of kind of how this stuff started. But yeah, a lot of volatility, but we're right back to where we started, right? And we've done this now a couple of times. We dropped in August 10%, and we rallied all the way back to up on the month in August. And then we had another big kind of short spasm in the beginning of September, and here we are back again. The buyback is a function of skew being really high and relative to where it's been, and in September being too easy to own like a SEP 30th or October behind a high SEP expiration. And as we get into this last 2 weeks, this window of non-weakness, I like to call it, right? We have all of these beach ball underwater. You guys have, that follow me have seen that retweeted again and again, but that beach ball underwater activity is a function of Vana and Charm and the buybacks. And the vol compression is a function of the VOMA Veda flows, that everybody is decaying longer. But that tends to be a very short, in this window flow, and we have to see whether or not we can get the pressure going on the shorts, right, to get the continuation into the back half of the year. I'll shut up for a second, but there's a lot more sitting out there after this. That's kind of a retrospective, and kind of where we are now. Going forward is very interesting for the next 3 to 4 months, and I think there's a lot of important flows that people should be watching for as well.
Great, and I'm gonna have you run through them for us, because I just want to say that I think one of the reasons that we all love hearing from you, and it's so important to look at this, whether or not you're actually trading options, but to just understand that these flows are out there impacting the market, which you and I have talked about a lot, is because it's so easy to be so confused. And we get these questions from people because they're like, wait a minute, I thought the AI bubble was bursting. What do you mean? What happened now? Why are we coming back? Should we be buying AI? It's so narrative driven, which I understand. And by the way, participate in, because that's how we kind of think about markets. But knowing that there are all these flows that we really have to pay attention to, and dynamics that are also driving, I think at least it helps me sort of understand, like, okay, I'm not crazy that this thing just U-turned in 2 weeks. It's not that the story's whipping around. There are other influences on the market. So I always really appreciate hearing about that. So what is interesting to you as you look out now toward the future? Because you mentioned, and I don't know if the US election is playing into it, because I'm just wondering, is it going to add to the volatility? I mean, it's certainly adding to the volatility in conversations. So does that have a knock-on effect in markets? How are you thinking about this?
It matters in 2 ways. The obvious way, which is policy, right? But that is a weighing machine aspect, and that matters next year. And in some ways, who gets elected in some aspects won't change things, and so we can get into that in a bit. But in the flows perspective, in the more short-term election focused perspective, it matters because you have a big event vol. You have a lot. What does that mean? That means there's a bunch of hedging at that time, and the outcome is speculated to be very important. So reflexively, there's a lot of hedging, which means it's very hard to hedge for the election because it's expensive, and that means dealers are short puts and long calls and in bigger size at a higher magnitude for the election. This is always the case, but particularly the last several elections, right? And what does that reflexively? That means it's going to be more volatile, for one, and for two, it means that there's going to be more Vana and Charm buyback as we come out of it, regardless of the outcome. So those supportive flows paired with a November and December, with lots of holidays after that, and an end of the year, if the market continues to be up, 15-16% like it is now, a really big buyback at the end of the year as well, all tend to lean very positive, despite, and not to mention, now we've had some period where people are a little more worried, more like that wall of worry has taken some long exposure off the books. People are kind of wait and see mode. The combination of that and just broad short interest, because there are, by the way, on the other side of this, reasons to be concerned. On the other side of this back half of the year, or last quarter of the year, there are reasons to be concerned. So that short interest also leads to something to burn to push this thing a bit higher. I think it's very dangerous to try and short this market into the end of the year. I would be much more productive and looking to buy dips. That said, and again, I think that was proven right throughout the last couple months. That said, I think we could, for the next 6 weeks here, have a period where potentially continue to be volatile until the election passes. So that said, markets don't tend to wait. The hard trade is always the right trade. The easy ones rarely pay off. So I think we're in a situation where going on, at this point, as we move forward, you really want to be productive, and it's okay to leave some dry powder for 6 weeks and look for opportunities to add. But I think shorting this market at this point is dangerous going into the last quarter of the year. Now, that said, I want to get to the final point, which I do think there's a real risk out there in this market come next year, come early January. There's a lot of historical anomaly, historical precedent for really strong election years in the context of much weaker dynamics. If you look at historically, and I think you and I talked about this, election years, and last populist cycles, I think our view on a 10-year, 15-year basis, when you really zoom out, is that this market is expensive. It has a lot of negative trends that it's up against in terms of secularly increasing interest rates, we believe, in particular, populism, protectionism, deglobalization, higher labor costs, higher cost of money. All those things are bad for earnings. It doesn't necessarily mean it's bad for GDP, but it's bad for earnings, and it's bad for the cost of money, and that's historically means to multiple contraction and margin compression. Those things are killers for stocks. So 68 to 82, which we believe is a similar type of period, rhymes at least, different in a lot of other ways. We've talked about before, but markets went nowhere and lost 70% of their value in a 14-year period from inflation. We think that's a potential, and at least in the general neighborhood of what's possible here for the next decade. So we're not the only ones, by the way, saying that this could be a lost decade. Druckenmiller, a lot of other people have talked about this for other reasons. But we strongly believe that's the case. We've said that for several years. We have net really gotten not much of anywhere. This year, people are very positive again, but we're marginally up in the last several years on a real basis. We believe that is we will mean revert again, and we believe that's probably from higher, like I said, at the end of this quarter. But we actually believe that that these election years, 68 to 82, 4 elections, average return 22% in those elections nominally. But if we look at the rest of the periods in that 14-year period, you take out those 4 years, the other 10 years have an average performance of down 8% in nominal terms and down 15% or so in real terms. That's the other 10 years. So again, not basing everything on these numbers, but that also happens for a reason. That's very qualitatively in line with what you would expect given the pressures in the system. There's been a lot of liquidity added to the system going into an election. There's been a lot of reasons for short-term optimism and narrative. But after the election, things get a little bit messy again. I would also like to highlight from a geopolitical perspective, the risks increase dramatically once the world knows who's president. There's a lot of uncertainty that comes off the table, and then things can start moving again in another direction. And I think regardless of who we have here, I think geopolitical stress, which we've continued to see more of, not less of, despite the sense of normalcy that people are beginning to look at it all through, can actually really cause some bigger issues for markets, much like it did in the 60s and 70s with the Vietnam War, with the OPEC crisis, other things. I think we're likely to see more geopolitical volatility post-election, which I think is something that people are kind of whistling by the graveyard on.
That is an excellent point. We could be sort of just in this period of waiting, and I don't think people have kind of considered it from that point of view. There's so much to take in there. And by the way, I know you can all hear it too. And through illness, this is the punishment of vacation, as we discussed. But you're being a trooper, and thank you for that. I'm going to give you a chance to catch your breath because I want to mention in the chat everything you just said. Is blowing some minds. And I'm so happy to see you all. Ralph, welcome. We were looking for you yesterday or Wednesday. But it's so nice to see all of you. And I know a lot of them follow your work, Jem. So they're sort of digesting this in real time. We have a lot of emojis, as you can imagine, when we're talking about a lost decade. And Christopher, let me know if Jem answered by laying that out. He was wondering if you were still on your aligned with your thinking from July, the beginning of July. I think he said July 9th. I'm not sure which interview he was referring to, but so I think you probably answered that, but Christopher, you'll let me know if he didn't. So let me just pull apart a little bit of that. So I think the concerns, those larger concerns you talked about for 25 are some of what has put fear in people. We do get a lot of people who, especially when we saw the selling, were so concerned about losing the gains they've earned, especially if they're closer to retirement. There's this sort of constant fear that I seem to pick up for people who write in. But then if you get this rally, this structural push that you're talking about to year end, it sounds like it's a setup, Jem, for people to kind of get like, oh, wait, I was wrong. It's okay. It's all bullish, and get pulled in at the exact time when they should be much more cautious as we turn the year. Are you concerned about that happening?
Yeah, I think the way people often confuse short-term moves and trading, and which involves a bit of speculation, right, over timing, with investing. I don't think of them the same way, and we treat them separately. To be clear, we do both. We have hedge funds, and we have trading operations that are proprietary. And we have a wealth advisory business, and that's much more long-term. We talk macro, and we have bigger long-term views, and we have short-term views. And I think you really have to think about them separately. I think from an investment perspective, I want to be abundantly clear. I don't think 60-40 is the way to invest for this decade or the next 15 years or so. Hopefully I've been abundantly clear there. The way to invest is through non-correlated investment broadly. You want to stay away from duration in the bond market, because I think that's very dangerous given the pressures that we have. Doesn't mean you don't take a T-bill yield and then use that collateral to stack yield above it, which I think is the right way to get your bond exposure, is benefit from the value of derivatives. Derivatives are capital efficient and allow you to stack a yield on top of your T-bill yield. So do that with your bond exposure. Heavy exposure to non-correlated alternatives. When I say alternatives, I'm not talking about private equity. I'm not talking about venture capital. I'm not talking about real estate. Those exposures are long the market, just with less mark to market, so you don't see the volatility. Those two alone should be able to constitute about 60% of your portfolio. And then go invest in the economy, not in the market. Those are two very different things. There are things that thematically work really, really well during periods like we've seen. Don't go passively invest in the stock market. You're looking for the experience that people had throughout the 60s and 70s. You're looking for problems. But if you're in the right industries, you can do quite well. There are lots of trends that you can benefit. Deglobalization is bad broadly for markets, but it's not bad for onshoring and nearshoring companies and local industrials. It's not bad for commodities and things that are that hold their value here locally. It's not bad for local domestic real estate, and particularly for millennials and on down, starter homes, et cetera. There are lots of trends that you can take advantage of in this type of an economy. It's not easy, but you need to be thematic, and you need to invest in things that are also value focused. A Warren Buffett value investing model, which, by the way, people laughed at, believe it or not, we forget about it now, but for about a decade, people kind of were laughing, like, he's underperformed the S&P for, well, guess what? He's back, right? And over the long run, if you do that, and particularly over periods like this, you do quite well. Stocks with negative working capital do very well with rising interest rates and inflation, and I think that's another thing to think about. Now, people are like, well, what if we don't get secular inflation? Like, what if I'm not on this inflation train? Well, these stocks will still do quite well. Maybe you'll underperform the stock market, right? You'll beat inflation. And it's a much safer, much better risk-adjusted way to invest for the long term. And given the risks and the probabilities of the things I've discussed, I think these are things that investors should be thinking about and be allocating towards, at least diversifying away from the 60-40 world, which is something that has worked very well for 35 years because interest rates have gone top left to bottom right. But I don't think you can rely on that anymore. And I think it's dangerous to follow every wealth advisor's advice, which is essentially invest in stocks and bonds, close your eyes, and hope they go higher. People think that's the only way to invest. Unfortunately, that's what they've been told, and that's not true. That's for the furthest thing from the case.
I'm so glad you said that, because I literally just saw something the other day saying, guess what? 60-40's back, because we saw movements in bonds, and, the conversation came up again. I think that's so incredibly important. And by the way, if some of these things are not things aware of, or if they're new to you, like yield stacking, right? This is we just got a master class in what to ask your wealth advisor. And if they're not giving you answers that are specific, or they don't seem like they are up to speed on some of the things that Jem just talked about, then that's a good time for you to take a good look at who your financial advisor is. Because I feel like we are in a different, and I know a lot of them are probably working hard to get up to speed too. We're not dissing financial advisors. I think that when you're in a changing regime, and that maybe that's the question, Jem, is this a regime change? Are we in a new era where everyone's going to go back and take a look at how they're doing, whether they're advising or they're getting advice?
Absolutely. Absolutely. The most important thing to how investments work over longer periods of time is the cost of money. And not just the Fed funds rate, but also what the 10-year bond is doing and where it's going. And what drives that is whether we're going through a supply side economic cycle or a demand cycle, and that is driven by politics. That's driven by what we as a people choose to value, and for a long time it was GDP growth. It was sending money through low interest rates to capital and globalization and corporate growth, right? But we're going through a period where people who have gone through that for now 35, 40 years and grew up in that period have seen some significant disadvantages of that. A lot of millennials are stuck at home with, mom and dad, or having a hard time buying a home. I feel like they and their parents have underperformed what they saw as the American dream, and that's causing some real political upheaval across the board. And that's not just poor white men in Appalachia. It's also poor immigrants in cities as well, and they react to the same thing, but in a way almost blaming each other. And that's not really the issue. The issue is inequality. The issue is Federal Reserve cheap money, which was supply side economics, globalization, and everything that came from the movement towards a global economy. And at some point, we have to ask ourselves, are we maximizing for mean outcomes, or GDP, or are we maximizing for median outcomes for our people? And that's the question that's being asked, and those policy changes and those debates are leading to different policy, and those policy changes. And that's not just here, by the way, that's in Europe, that's globally. And those questions are leading to different policy that have dramatically different outcomes on a secular basis to markets, not just bond markets, but importantly to equity and risk assets as well. And that's what we're experiencing. We've been experiencing it for 3 years or so now. And we believe this is not a 3-year phenomenon, much like the other phenomenon, the other regime, to your point of regime change, was a 35 to 40-year phenomenon. We believe this is at least a 15 to 20-year phenomenon, and we're about 3 years into it. So buckle up. It's a different world. Again, it feels like other historical periods, but people have to look back 40 years. And 40 years for your average wealth advisor, your average person, seems like forever. I don't think anybody shows you their 50-year, 100-year track record, right?
Yeah,
They
well,
show
listen,
you their
most people
5-year,
were doing it,
10-year
right?
track record, right?
Yeah,
And so yeah, you have to think about a different world. And then 60-40 worked so well, and it was easy because it was low cost. And all that mattered was low cost and scale and get more assets. And if you only have to show 10 years or even 20 years of returns, why would anybody else look any further, right? It's cheap. But there's a reason hedge funds and non-correlated assets were so popular in the 60s and 70s. Derivatives were started. The CBOE and started in 1972. There was a reason those things started, because when interest rates are higher, you need capital efficiency, and you need to invest in relative value opportunities across the market. And that's gone out of favor. Everybody says active management is dead. Why would you invest actively when you could just passively close your eyes and buy things for the long run? Well, I think we all know that there is such a thing as education, and that there is such a thing as people who know things more than other people and can do a better job. It just wasn't valued, because the amount of value that was added and the cost it took wasn't worth it relative to just closing your eyes, buying assets, and holding on for the long run. Well, when that's not the case, those other things matter again, and that's the regime we're in.
This education is what prompted one of your followers to say that you are from the future, which, I laughed so hard when I saw that, because I always end these conversations with you kind of with that same vibe. And I retweeted it because it was so funny. But it was such a sweet compliment, but actually very true. Want to ask you real quickly, you talk about higher interest rates as part of this thesis of yours. What is going to be the spark to push those interest rates higher? Because we sort of see them declining a little bit now. The Fed's cutting interest rates. And what's the time frame for that? Is this part of what you worry about in 25?
I want to be clear. If you look at, again, I hate to always refer to the same data set, but it's the last data set that we have. And these are long periods, right, where interest rates actually went bottom left to top right, where they increased, okay? And if you look at that 68 to 82 period I've talked about, a lot of the same things were very present. What are those things? Higher fiscal spending. All of them were driven by populism, right? This populism we've talked about, which was generational. We got fiscal spending in the Great Society program, right? That was a significant driver of the initial inflation. We had deglobalization and the protectionism that came with that populism as well. That deglobalization led to higher labor costs. which is a significant driver. It also led to global conflict, because what happens when you're no longer, when you're sending money to corporations and they're investing abroad, and everybody is happy. We have everybody's working together, and well, this is not a competitive landscape; it's a cooperative landscape. And when we go to protectionism and we start throwing up walls between China and other countries, it's a little bit more contested, right? And there's a little bit more competition. And that does eventually lead to global strife, because people aren't okay with the biggest country in the world trying to keep all the things to itself, if you will, or do what's best for its people maybe, but not for the other people of the world. This is competition, right? It's a natural phenomenon. And that ultimately leads to problems. China right now is in a tough spot, right? Because the U.S. is putting up walls. Their economy is struggling, and Russia has been put in a tough spot for several reasons. And both of them are looking at each other. Old, proud countries and people, and you have to understand their situation as well, right? And they both have weaknesses in their own right that they need to benefit from an alliance. So they banded together in opposition to the U.S. And guess what? Iran is in that mix too. And if you start to look at what's happening, right, there is alliances being formed, and it's becoming a very global conflict. We're already amidst you can call it World War III, or you call it, we don't need to be bombastic, but a global conflict at scale. And that's an economic war. The CHIPS Act is economic warfare, right? We are in a physical war. It started with Russia invading Ukraine, and the second front is Hamas and Israel, and what we're seeing in the Middle East, which is really Iran versus Israel, right? Which is another part, the second front on that war. And you better believe there's a third front coming in China versus on Taiwan. Don't mean to scare anybody, but this isn't new, and the reasons for it are very clear. But it's driven at its core by populism and a desire to make America first. Make America great again, fine, but guess what? Everybody doesn't want to make America great again. That's not in America. And so that's not a political comment. That's just the way, that trend and that desire to make America great again, right? And be in that populist rhetoric. And by the way, it's on both sides. I don't want to make that, I want to be very clear. That's, you get the same commentary from AOC and, Bernie Sanders, who are very populist on the left. The whole Democratic Party has always been a populist, right? So I want to be clear. Both sides are driving this. This is driven by the people at the core, and it's taken the Republican Party, which was left, kicking and screaming, and the left even further left. And we are in a world that is heading down this path. So I don't know if I answered your question at the end of the day, but these are secular trends, and those secular trends are inflationary at the end of the day. They're inflationary because globalization is deflationary, right? And then protectionism is inflationary. At the end of the day, we have limited labor supply now. There's no way to go export labor. We can't import. We have to produce our own manufacturing and do our own things, or do it at least with allies, and that limits the sphere. Labor costs go up. Guess what? We are seeing more labor rights, more populism, more unionization, and higher.
Boeing's on strike
pay.
today.
Yep,
Boeing
exactly.
workers are on
So,
strike today.
yeah, there's commodities. Luckily, we have a lot of our own commodities here in the U.S., but that's a constraint for countries as well. Movement of capital, all kinds of issues that ultimately drive higher costs, and that higher costs again cause multiple contraction, as well as margin compression.
So and we'll leave it for another day, because of course there are people who have a slightly different perspective, and even an opposite one. And time frame matters. But I think that the big takeaway for me, and I think everyone listening, is you have to hold both things in your mind, right? You have a thesis that is a longer term change in regime, as you said, these secular changes, and then you have a shorter term view that has to be very different based on the flows you see, and you have to think about both of those things with an overlay. and just not jump into the narrative of one, which I think is what happens all the time
Totally.
on X. And it's natural, right? Like, how much can you say in a little short,
And
tiny
people
tweet?
capture
But
like long-term narratives more, and people invest more, and people aren't necessarily trading as much. So they get really, but then they're looking at short-term performance, and they expect, well,
yes,
I'm investing for the long run. A great example would be tech. Tech was a great investment in 1995, right? Long-term investment. There was a super cycle, and you should have been in all the growth names. You should have been 100, buying every dip you could for those 30 years. It didn't stop. Things went too far, too fast, right? And we got a massive liquidation, and 97% of tech names went out of business. Doesn't mean the internet and growth names and investing in that way wasn't the right way to invest. You made a tremendous amount of money if you continued to buy the dip and invest in tech and continue to take that global and tech perspective all the way through 2022. For again, think of it as 30 years. But guess what? They got a 2-year period where you lost 70% of your money. And so there's a long-term perspective, and there's the big picture, and then there's where are we cyclically, what's happening to valuations, what's happening to positioning, how is this path going to lead before we get to XYZ place. And those things are done, more a function of the weighing, the voting machine and all the flows that we talk so much about.
yeah, and which are so important.
Yeah.
But I think this is as always so enlightening for us, Jem, and so helpful for people as they try to think about this volatility and what it means. And you're right, we all say we're long term, and we all freak out when we see the short term, sort of month to month, and you check those, your holdings. So some super great advice. We're going to break it down, and we're going to revisit these themes as we move through and talk to you through this period, because I think we always want to be sort of checking in so that we understand what's happening in real time. Jem, thank you so much. Thank you for battling
Always,
through illness and crazy re-entry.
always a pleasure. Always enjoy being
He's like
here.
he's literally dying on us
Sure.
on screen right now.
No, I'm actually towards the end of the cold, thankfully. But
Good.
no, thanks for having me, and look forward to kind of being in touch and
Patrick,
doing this
wheel him
regularly.
out and get this man a cold beer. He's gonna need it as he goes
A
into the
nap. I
weekend.
think I need a nap.
And nap too. Yeah, great. Well, fantastic. Thank you so much. Thanks for the great chat. There's so many questions and things we could explain and break down, but we'll revisit them. We're gonna bookmark them all, and we'll get into some of it next time Jem's on. So thanks so much.
Thanks for having
Thanks,
me, Maggie.
everybody.
Take care.
Make sure you subscribe and sign up for the email link so you can keep track of what's going on. Noelle is with us, and we will check in with both macro and crypto with her on Monday. And as always, everybody have a fantastic weekend. Take care and good luck out there.